take us through the commodities sector is Peter O'Connor from Shaw & Partners, and he joins us now live. Peter, always great to chat with you. Just checking in on those miners. How are you looking at the commodities space as we sit in this afternoon session?
Well, it's good to be back, and looking at the commodities space, it's busy is the short answer. There's so much going on. It's supposed to be quiet in May and June in every year because it's between reporting seasons and AGMs are over, and it should just be a period where I can catch up. But there's a lot happening, and a lot happening across a broad range of companies and a broad range of commodities. So whether it's macro and Chinese data or US data last week, or it's the bottom-up data coming out of some of the mining companies with a lot of announcements pending, there's a lot happening. So iron ore clearly gets a lot of headlines every day. It's down overnight, on Friday night I should say, but it's still holding ground above $200. We do think and continue to think it will settle lower as the year progresses and as the construction season has peaked in China and weather has changed, and that should start to slow things down. And we're starting to see that manifest in steel price already. So margins been tweaked a little bit on steelmaking end, so iron ore price should see some reversion below that $200 level. But again, busy across the board from gold through coal, through the big caps, and a lot of the commodities across the deck as well.
Down into some of those specifics. Coal is definitely on your watch list. WHC also in the picture. Walk us through some price action. Yeah,
look, it's been fascinating. Who would have thought that the energy complex as a whole, so I'm not just thinking coal, but energy, LNG, oil, gas, uranium, have all done well as the COVID recovery has unfolded and as stimulus around the world has driven economic activity, and that's driven the demand side, and we've seen some pinches in supply, but overall the trend in energy higher, and coal's been dragged higher along with that as well. And last week we printed for thermal coal, and not just a 2-year high, which it went through, but a 11-year high. So we're now back at prices last experienced around 210, 211. So quite a vibrant pricing regime for the thermal coal miners, but also met coal, metallurgical coal used for steelmaking. It's had a fantastic month. In the last month, it's been galloping ahead. It's now about 55% from its low of it, just over $100 US per tonne. And that move's been quite dramatic, and the names of the likes of Coronado Coal probably wouldn't have had to do an equity raise had they had the price today when they did their raise about a month ago. So that sector's enjoying that returns. It is longer term on a slippery slope lower, but we're on the right side of a trade which is cyclical and reflecting that energy recovery as in line with COVID. But you mentioned Whitehaven. It's a standout because last time coal prices were at this level back in 2018 and even 2010-11, the share price is trading closer to or above $6 per share. And today, if you look on the screen, it's probably closer to about $1.65, $1.75. So there are some operational issues, so it's not a like-for-like comparison, but when it does address its issues, which they are due an announcement any day soon in terms of how they're going with recovering back to normal production at one of their key mines known as Narrabri, which is an underground coal mine. That should see the gap start to close between what it should trade at, which is probably in the $3 range, as opposed to where it's trading at today, sub $2. So Whitehaven's looking really interesting from that value perspective if they can deliver better, more stable production. So coal space, it's not the one you normally want to look at because everybody seems to be having a view about the long-term decline of coal, but there's a trading, and I stress trading opportunity in the near term, which is cyclical more than structural. In fact, the structural trend is still likely lower.
All right, I know you've been looking at capital in the coal sector. I know also New Hope, but I guess if you could try to look at a greener or less dirty coal, then it would be met coal rather than thermal coal. So what do you like in that space?
Yeah, look, you're right. The one that we do need, and part of this, Mike Henry talked about it, the tussle or the dilemma between economic activity and growth and also maintaining the green decarbonising footprint. And that in the middle there is metallurgical coal for steelmakers. We need steel. We need to build things to improve the decarbonisation of the world going forward. And so met coal, what do you play? The pure play engine by Coronado Coal, which, as I just mentioned, they wish the price had been what it is today a month ago because they probably wouldn't have had to do an equity raise. So that would have been less dilutionary, but now that's done. Their balance sheet's recapitalised, their debt covenants have been pushed out. Coronado Coal, if they can deliver coal into this market, they'll be doing a lot better than they were just last month, and again, $50 US per tonne better pre-tax, which is a huge turnaround for them. And as you work your way down through the more diversified chain, South 32, it's a large producer of thermal coal, and it's about 25 to 30% of its business, so it's also enjoying that delta on its revenue, feeding into the earnings for the company as well. And at the very big end, and probably a little bit diluted, but BHP. Don't underestimate with about 70 million tonnes which it manages in Queensland, of which about half of that's its share. It's a big player in the metallurgical, in fact it's the biggest player in the market, but it still has an equity lift, and that could be one of the deltas that offsets some of the iron ore softness that I mentioned earlier. So from the big end down to the small end, there's ways to play the metallurgical coal upside.
Let's drill down a bit more into BHP and what's happening with that company at the moment. We just checked in on the stock price, but there's a bit going on, Peter.
Yeah, look, I just wanted to so-called plant the seed on what they're going to do in the next month or 2 or 3, and that's to do with potash, and it's to take the company to another level. And this is a company which has been around for several hundred years, it's got a long pedigree, one of the largest in Australia, but it needs to do something to change the business model that it's got and to take it another step. They've got a mature iron ore business which will continue to grow, but very modestly, a metallurgical coal business, whilst it's enjoying price uplift at the moment, it really does look mature in terms of volume. Their copper business has got growth they've talked about, but again, it's largely capped. They need another business, and what they're going to possibly move towards in the next month or 2 is potash. This has been on the back burner for about 15 years, so it's not new, but it's coming down to a decision point. So Mike Henry, the CEO, has talked about making a decision, or the board, making a decision by mid-year, but mid-year they've said really is about August, September, so it's not mid-year as we expect, but it's getting close. But what was really interesting last week, in discussion with BHP, and suddenly an announcement popped out where they're going to have a potash teach-in this month, 17th of June, next week. And that's about pricing for potash, the structure of the market in potash, how you think about long-term potash prices, given not many people know much about potash. And if it's going to be a big deal for BHP, they need to educate the market. So as a precursor to a big announcement, that's part of it, but they do look like they're heading in that direction, and they like the long-term strategy of the green, plus feeding the world in terms of maximising yields on crops. So it fits that platform. It could be a GDP plus growth scenario. Most of their commodities grow at GDP less scenario, so it gives an opportunity to deploy capital, to recycle capital, and to have a business which will grow. So a lot coming out with them in the next month or 2. And if I could use an analogy, because I want to keep working on this one, is that think about Fortescue, 2007, 2008. They were the little guy. They were not in the market in iron ore. They wanted to be in the market. They were challenging BHP, Rio, Vale in Brazil. Everybody said they couldn't do it. There's no chance. You'd never fit in the market. You'd never get the price. You'd never make the returns. Crazy, go away. BHP is a bit like that. So they're almost like the FMG in the potash market. They're the new player. They're not even in the market.
Yeah.
And they're trying to change things by building a brand new mine, the first new mine in 20 years. And like Fortescue, when you build a new mine, it's probably better than the old guys. So their costs are cheaper, which they should be. And likewise BHP. So returns may not be super right up front, but it's a long-term business. And like iron ore, it may take a decade or 2 to get there. But when it does start returning, it could be a very good harvester of capital.
Yeah, it's a really interesting sector to be in. I think, in fact, the Financial Review had an article on it this morning saying there are 5 local mines that could be producing that fertiliser inside 4 years. So clearly, a lot of movement in that sector. Peter, we'll keep an eye on that. Thanks so much for joining us from Shaw and Partners.
Thank you.